Hi, good evening. Welcome to what we have learned for today, which is the date of 28 April 2026 for Lawsome. Now, the first thing is the major differences between the LLP and the LLC when it comes to the earnings, which is sort of all considered under the umbrella of earnings. The second thing we'll be going through is the tax calculation. So, without further ado, do the earnings of a business entity differ from the earnings of an individual working within the entity? So for this kind of question, the first answer that comes to mind is depends. Why? Because there are four entities, right? So the first entity is the sole proprietorship. Now this is straightforward because the business entity, I'm going to increase the size. The business entity is the same as the individual. So as a result, there is no difference, right? Whatever the individual earns or his income is taxed. Income is taxed. Okay, green for income. Okay. Now the second entity is a partnership. Partnership is similar to a sole proprietorship because there is no business entity also. So I'm just going to duplicate this. There is no there's no difference between the business entity and the individual. So business entity equals to the partners. But how are they taxed? Well, the income is taxed based on the portion of the partnership share, based on income of the partnership share. So how is this calculated? That's where your things like your partnership agreement come in. Now at this juncture, what I want to bring attention to is, I'm going to write in red, personal income, or rather salary, includes sources of income such as rental, for example. And the reason why I share this is as we progress to the third and the fourth business entity, you'll realize that there's not just one avenue of income, and this will actually affect how the income tax rate is calculated. Now, this is simple, okay? This is just warm up. This is just a prelude to what we're gonna actually be going through for most of today. Now, the third entity, as you can recall from the first tutorial, is the LLP, right? Okay, so if you can recall from tutorial 1, how is this entity taxed? So one thing you understand is there's a separate business entity, right? Separate legal entity, right? But the partners are taxed on, firstly, personal income. This makes sense, right? Whatever money they have to pay a bit of it to the government, personal income tax. And then another thing you need to know is the profit attribution, profit attributed to them. Okay. So, to give an example, this is your LLP here. Okay, it's your LLP here. And let's say it has made $1 million in profit, 1 mil in profit, right? Then there are two entities, or rather two partners, Mr. X and Mr. Y. And they both have a 50% share. Okay, I'm gonna highlight this in yellow, right? Because this is related. So they have each a 50% share in company. Sorry, not company, in the LLP share. Then on top of that, they actually get 100,000 salary. Salary, 100K salary. Okay. So the question right now is, how are they going to be taxed? So the first scenario, scenario 1, is the LP pays out, right? Pays out according to the shares. Pays out the shares. Now this is very simple. That means both Mr. X and Y, Mr. Y, they'll be taxed for the 50K. No, sorry, not the 50K, the 100K plus the 50% of 1 mil, right? Percent 1 mil, right? Text on. This makes sense because they'll be receiving this amount, and as I mentioned earlier, the personal income salary actually includes other sources like rental, and in this case it's not just the salary but also the shares. So this is how much they'll be taxed on, and for the first scenario. For the second scenario, LP does not pay out the shares. Pay out the shares. This means to say that the $1 million profit that the LLP has garnered for that assessment year is not going to be touched by Mr. X and Mr. Y. However, as you can recall here, the partners will still be taxed on their personal income and also the profit attributed to them. So what this says is that the IRS does not care if the LLP actually gives out the $1 million profit in the form of 50% share to each Mr. X and Mr. Y. Doesn't care if LLP pays out or not. As long as the LLP has made a profit, Mr. X and Mr. Y will be taxed based on their share and the personal income salary. So this is to say they'll still be taxed accordingly. So there is no arbitrary difference between the two scenarios. So you may be thinking that I'm full of shit. Well, where is actually the authority for this? Well, if you go to the slides in LMS, you can scroll all the way down. You can, let me find where it is. Okay, so look in here. See, LP partnership sole proprietorship tax on individual income tax rate. There is no mention of a corporate tax. So everything that the entity receives, it essentially is assumed to be entering the pockets of the partners, Mr. X and Mr. Y. So the IRS will tax them accordingly. So as you can already see, the advantage of an LLP, right, is that no corporate tax. However, it's a bit risky, right? Because you're not guaranteed to actually receive the shares, but you'll still be taxed accordingly. The IRS doesn't care if you have actually earned the 50% or not. They'll still tax you and assume that you have received it. So IRAS presumes partners are paid their shares. Okay, now we're moving on to LLC. All right, now we'll be moving on to LLCs, which are the same as essentially companies, So as you can already tell, the first distinct feature of an LLC compared to like a sole proprietorship and the partnership is that it's a separate business entity. Another concept you need to know is that there is a corporate tax rate of 17%. And last thing you need to know is that dividends are not taxable. So where do I actually get this corporate tax rate of 17%? It's actually in the slides here, right? It's a flat rate of 17%. Okay, so with that in mind, let's give a similar example. For the sake of time, I'm just gonna copy this. LLC, right? there's a 70% corporate tax, so 70% of the 1 mil will be reduced first. Then the balance is actually 830K after you minus away 17%. So as you can already tell, the difference between an LLC and an LP is that firstly, there is a corporate tax. So I'll just write it down, corporate tax. Okay, now we'll revisit this later. As for the salary, it works the same. Okay, it works the same. Mr. X, Mr. Y, 100K, 100K. Now, as you can see here, the 50% shares, right? They'll have to be paid out in the form of dividends. So dividends is basically the way the company pays back the money to the partners, right? For LP, we don't call it dividends, we just call it shares. But for LLC, we call them dividends. So it's very simple. You just take 830K divided by 2, 830K divided by 2, because each person is entitled to 50% shares. Now, so the total income will be, if you actually work it out. Now, as you can recall, I mentioned that the dividends are not taxable. So in this case, only 100K will be taxed. Only 100K will be taxed. And dividends will not be touched. So the advantage of a LLC is that, okay, I'm gonna write here, members, or rather shareholders, they are only taxed on personal income tax. We compare this to an LLP, where they are taxed based on personal income tax and profit attributed to them. So you can say another advantage of an LLC is that there are lesser taxes for individuals. Now, with that in mind, let's actually look at how income tax is calculated. So for that, you actually need to go back to the slides. Okay, here, so okay, this is quite straightforward. Let's say, the example was by the 50% of $1 million is 500K, right? So the total income they receive is 600K. So let's use 600K as an example. So how to calculate, so the issue is how to calculate 600K in personal income tax. Okay, then the law will be actually the table here. So we'll actually be using 1, 2, 3, 4, 5, the fifth row. So you look at the fifth row, first 500K, right, is taxed, bro. First 500K is taxed on 84,150. Next 500K is 23%. Okay, so applying the law, first 500K, 84,150. So then, what is 600 minus 500? What is 600,000 minus 500,000? Yep, that's right. The balance 100K, right? It will be 23% times 100. Sorry, 23% times 100K. Yeah, 23,000. So then total tax payable will be 84150 plus 2300. Yeah, and you can work it out. So the takeaway here is that it doesn't matter if it's $500,000, 500,001, or 600,000. Okay, the moment it's considered the next part of the next 500K range, you have to apply this tax rate. right, of 23%, and there are different, there are different roles for it. So that's what we call a tiered system.